Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm a financial advisor, not a professional YouTuber. But this video is not financial advice. But you might get something out of it. You might learn something, maybe a little bit of education, a little information, a little bit of inspiration, a little bit of clarity on GameStop, the business from a level-headed perspective, not hopium, right? Not necessarily just interpreting memes and tinfoil, but really looking at the numbers and figuring out what does this company fundamentally support. In this video, I want to talk about the implications for GameStop's software business in light of what Ryan Cohen just said. So we've been breaking down this hour-long interview that he recently just did. You can watch my recent videos with the takeaways. One of the takeaways was related to the software business. And I want to extrapolate what can we learn from what he said as far as the probability and the different scenarios from a floor, fair, and fly case of how you would value their software line. Before I get into it, I just want to say thank you so much to the channel members, channel subscribers, the commenters, the likes. I appreciate it so much. We have 201 spots left in the Y2K sub club. So if you want to be a part of it, there's only 201 spots left. Also, thank you to those who join as fans and friends. Extra perks and just extra support. Go the extra mile to help the channel. Get this, guys. Channel update. So in September, right, this channel made $301. I just received it yesterday. Check it out. That's a screenshot from my PayPal. $301. And as you know, or maybe don't know, 100% of the earnings of this channel go to DRS booked GME shares. So the first step, boom, we transferred funds into Fidelity. There's that 301.78. And that cleared 13 shares with a cost basis of 22.35. So Budget for Life, you guys, this channel together, we have our own infinity pool of 13 shares. Once these shares settle, I will be able to transfer them to Computer Share and get them into that final DRS booked, staying there forever position. So super exciting. We will see if we can break that 300 number in October. But 13 shares strong, guys. Way to go. Way to go. So, what did Ryan Cohen say? He said he's not getting into game development, and he's going to focus on playing it safe as it relates to software. What does that mean? It means that they're going to keep doing what they are already doing in the software space. So I had talked in a video a while back on, why GameStop is not going to just discontinue its software business, why it's not going to go to zero. And the best case is really that grading turns software into collectibles, but there are also just strategically, there is a value proposition to physical games that digital games does not provide. It's a decreasing portion of the market share, but it is a portion of the market share, and it's not like it's not going to just evaporate. Some people genuinely prefer physical games. Will even pay more sometimes to have the game in physical fashion. And then you just have GameStop, the business, and how it has continued to operate efficiently as it relates to software. Their margins on their software line likely 30+%. And so is GameStop interested in that just going away? No, but they are not going to invest in it. Ryan Cohen said, we operate our software business in a CapEx light method. Easy returns, no moonshots. What does that mean? It means if you want to trade in a video game to GameStop and receive, 40% of its resale value, GameStop is happy to continue buying that from you and selling it to the end user and making that whatever 50, 40%, 35% spread on the used games. It actually is probably more like 50% margins, and of course selling new games as well at around a 20+% margin. All that to say, the valuation scenarios. So in this worst case, what we talked about was what if they kind of start out at a $750 million annualized revenue for their software business, declining 25% year over year? Now, this is basically what it has been doing. The software business has been declining around 25% year over year and is on pace to end up around 750 million for the full year of 2025. So the worst case is basically all these downtrends that we're continuing to see just continue until you reach the floor valuation, the floor market for physical video games, and how low could that floor be? Now, we assumed that they were netting 28% margins in this case. I think that number is too low in light of what Ryan Cohen just said. He is focused on easy returns. He's not interested in low margin software business. He's not even really interested in competing in the digital software space. That means that even though GameStop's software top line may continue declining, the profit margins are actually going to remain pretty high because they are only a larger portion of their software sales are going to be used games. It's going to be used software, which we know. I can throw this in here. We know from their 2018 10K, back when they used to split this out, that their pre-owned products was 43%. But we also know if you read through this 10K, this includes consoles and software, and that the margins on software, pre-owned software, were substantially higher than the margins on pre-owned consoles. Consoles, it might be around 25%. Software might be around 50 or 60%. All that to say, the new software back in 2018 was 21%, but we also know that GameStop as a whole has improved their total gross margins since back then. So could both of those numbers be on the low end? Certainly. When you average it all together, there's really no case where this 28% margin makes sense. You could argue that the decline is going to escalate, that it's going to start declining even faster than it already has. But I think um, there's enough value as far as GameStop software business that I don't think it's necessarily reasonable to expect these software sales to decline even faster than this. Even if market share declines faster than that, what am I trying to say? Even if the transition from digital or from physical to digital slightly increases or increases even faster, the total video game market is a growing market and a huge market. So again, to imagine physical software falling off a cliff very quickly, not necessarily super reasonable. I'd say the kind of lowercase margin scenario on their software business, in light of what Ryan Cohen said, is that it's actually going to be a higher margin business. And so I would say the low case scenario is more like 33%. And when you net out 120 million of SG&A, where does that put us? So we are taking that 750 million and saying if 33% of that is gross profit, that's 247 million. You take out 120 of SG&A and you are at 127 million of net income from their software business in 1 year. But then you're projecting this decreasing each year by 25%. You're basically projecting that the top line is going to keep going down by 25% and um, that the SG&A will more or less remain static. It's going to cost just as much to run the stores, to do the trade in business, but it's just going to be a lower and lower portion of those stores' sales. And so it's going to take too long in this video to update all of these numbers because I also discounted these from a present value perspective. But suffice it to say, all these numbers are a little bit higher. Um, I guess you could say they are. I mean, let's just get an estimate for 2026 to give us a ballpark. So if they make 127 in, yeah, we just basically take 25% off of that. And so then it's 95 in 26, 72 in 27, and 54 in 28. And I'm not going to discount those present value right now. I guess I just might as well. That's what we're doing in this video. So if you want to take the present value and you just discount them by 11% annual returns by the amount of years. So 95, you say, okay, 89, you take out 11%, right? Because it's 1 year out. So 89% of 95 gets you 84.5. And then you do it for the 72 times 89 times 0.89. That's a present value of 57. If you're learning anything in this video, drop a like. 54 million. That's 3 years out. So that is worth 38 million in today's dollars. Then you talk about what's the baseline of this software business? Like how low does it get? And I think 18 million is very conservative, especially if even with 25% year over year declines for 4 more years in a row, you're still clearing 50 million in net income, like in bottom line net income, right? Operating income. And so to say that that's going to go all the way to 18, right? It's just like eventually it will fall very, very low, but they're still going to be able to make some money on this business. And then to give that a 10 PE, I'd say this is more than fair. If anything, I'd say this is probably more like 25 million as far as what is the, like, where does physical software bottom out? And I'll show you how this impacts the business valuation here in a second, because basically on the front end, you're just adding up the present value of 1, 2, 3 years out plus this year. So 127 plus 84.5 plus 57 plus 38. So that's $306.5 million that basically the software business is going to clear in these next 4 years. And then you talk about how much are they going to make after that and what type of PE do you give that. So you could say they're going to make, so basically the worst case is that this is 306.5 plus whatever you describe their future to be. If you think they're going to make 25 million a year and you give them a 10 PE from there, then that would be another $250 million. So 306.5 plus 250. All of a sudden, this is a $556.5 million business. If you want to say that they're not going to make 25 a year, or if you want to say, hey, I want to give this a 5 PE instead of a 10 PE. Like, sure, maybe it stables, but after that historical decline, you're not going to give very much of a PE for that. I would say that's a fair argument. In that case, you would say instead of adding 250 million to the tail of this valuation, you'd say I'm going to cut that in half. I'm only going to value that at 125 million. Then this would be 431.5. Now, what's the likelihood that this happens? I think Ryan Cohen is telling you that this is more likely than what we would have originally projected. And what we originally projected put this business at around a $2.2 billion valuation altogether. But even though the margins are going to be higher, the cash flow is going to be solid because it's shrinking, because they're not investing in it, because like in light of that, you're not going to be able to give it a very high multiple. And it's also more likely now that this happens because Ryan Cohen said they're not going to invest much in it. So I would put this at like a 50% chance in light of Ryan Cohen's interview, from a 30 to a 50% chance. Now, what's the fair case? Obviously, we're going to have to adjust these percentages because these three percentages need to add up to 100. In the fair case, we're saying, what if they do 800 million? Now, these margins, again, we want to up these margins because a higher percentage of their software sales are going to come from used software, which is a higher margin than their new software. I think 36 even is still a little I'm going to call this 37 in kind of a base case. Now, saying that 0% growth year over year, I think a lazy but simple way to calculate this. So if you take the 800 million, you say 37% of that's profit, that's 296. You take out the 120 of SG&A, and you have a 176 million net operating income. Now, the odds that we have 0% growth, I think, are actually low. I think a more realistic fair case is that they can slow down the decline and that the floor of how low does it eventually get to is higher. I think a more likely year over year growth is say, well, what if it goes from shrinking at 25% year over year? What if you say a lot of that was related to GameStop store closures and a lot of that was related to a weak portion of the console cycle, right? We're entering into a new console cycle, which means new games. That's going to help, buoy the software sales up. And even though the trend from physical to digital is continuing, in light of the fact that we're just now starting a new console cycle, maybe GameStop can kind of slow down the shrink from their personal used software business. And so you'd say, what if this was minus 5% decline year over year? And what type of PE would you give a company that is declining at a 5% rate? It's hard to say because it's not going to necessarily decline forever, right? So the next question is, how low does it get, right? Like, how many years does it decline until they find a floor? And then what type of valuation do you give that floor? And I think for all intents and purposes, I mean, the 176, right? You take that 5% decline for a couple years, and then you do the PV of that. You're talking 176 of money they're going to make this year. That's basically cash in the bank. So it's worth at least 176 million in this case. And then next year it's going to make 167, right? And then the next year it's going to make 155, right? And the next year it's going to make 150, right? So how many years do you think they can maintain the negative 5% decline? Because each one of those years is another 100, 110, 120, 150, 170 million dollars of cash. And then you discount that, right, with how many years out and what is the opportunity cost? Where else could you have invested? And then what's the floor? I'd say the floor is, let's say they get down to a $50 million valuation eventually at a 5 PE. So eventually, still, it's going to shrink, and you're not going to give that shrunk business a high valuation. but that 50 million times 5 is about a $250 million long tail valuation for the software business. And how many years would it take of 5% declines for you to even get there? Like 176 times 0.95. That's one, two, three, four, five, six, seven, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24 years. If it's only declining 5%, is how long it would take to reach that long tail. So, to do the present value of 24 years would be honestly pretty ridiculous, you know? So I think it's really like, what type of PE do you give this 176? Because no one is going to realistically do a PV of 25 years of cash flow, right? It's hard to project that long. So basically, if GameStop can slow the decline, then it's just a question of what type of PE do you give a company that is slowing. And if you look at Best Buy, for example, their top line has been slowing for several years in a row. They get a PE of 18, right? So like companies that, um, oh no, companies that are shrinking do trade at a PE discount from the market, but the S&P 500's PE is 31. So what type of PE do you give this? If Best Buy is at an 18, it's hard to say it should be much less than an 18. I'd give it a PE of 15 in this fair case scenario. And what does that mean? 176 million times 15. This fair case becomes a $2.64 billion business. What are the odds of this? I'd say this is still pretty reasonable. I would call it a 45% chance. And now, what do we do with the fly scenario? First of all, we're saying this is a 5% chance. And the only way this happens is if collectibles, like if grading of video games creates a renaissance for the software business, which we know that Ryan Cohen is not going to try to make that happen. If that happens, great. But GameStop is not trying to do that. They're not investing money into their software business. They're just taking what comes, right? And so the odds that grading, basically the odds that PSA on PSA's back that GameStop's business can crush is a low chance. But what do you call that kind of starting point? I'd say the starting point generously, if you think that, Pokemon Z to A is going to do bonanza's money, you might say that right now they're doing 900 billion in annual revenue. Gross margin wise, you could argue a 45% margin. But then, which means they're netting 405 minus that 120. They're netting 285 in net SG&A, but this growth is still going to be modest. Like the collectibles business growing is not going to change what Ryan Cohen's saying about the transition from physical to digital. And so you're going to have the collectibles value of software growing while simultaneously the new software sales shrinking. And you'd say, what if it nets out at a 5% growth? What type of PE would you give that? Maybe a 22 PE, right? Nothing too impressive. So a 285 times 22 is a $6.27 billion business. And I think based on what Ryan Cohen said, it's less likely that happens. So what happens? A business that we thought might have been worth 2.2 billion on a weighted average basis is actually worth maybe about 1.7 billion. But the floor scenario is actually much more encouraging than what we thought before as well. All right. That is all I got for y'all in this one. If you learn anything, drop a comment, drop a like, any other thoughts you want to share. We'd love to hear it. We'll do this for the interview implications for their hardware business and for their collectibles business as well, because it's going to get more encouraging from here. But I wanted to give some justice to the software business also. All right. Thanks for being here. I will see you in the next one.